Securities Transaction Tax, STT, introduced in India in 2004, aims to reduce tax evasion and generate revenue from share transactions. The Securities Transaction Tax Act governs STT's application, which applies to listed shares bought or sold through recognized Indian stock markets. STT specifically covers shares listed on exchanges, derivatives like futures and options, units of mutual funds primarily invested in shares, and unlisted shares sold during initial public offerings, IPOs, and subsequent listing. However, STT does not apply to deals outside the stock market, bonds and debentures, except in certain cases, and trading in currencies and commodities. The STT rate varies based on the transaction type 1% for both buyers and sellers when taking delivery, 0.025% for intraday sales, 2% for futures contracts, previously 0.0125%, 1% for options contracts, previously 0.0625%, 0.001% for selling units of equity-oriented mutual funds, and 2% for unlisted shares sold during IPOs. STT is calculated based on the total value of the securities bought or sold. For instance, if you buy shares worth 100,000 Indian rupees for delivery, you'll pay 100 Indian rupees, 1% of 100,000 Indian rupees, as STT. STT offers tax benefits to investors. Short-term capital gains are taxed at 15% instead of income tax rates, while long-term capital gains over 1 Indian rupee lakh are taxed at 10% and are tax-free up to 1 Indian rupee lakh. STT ensures tax compliance, clarifies financial markets, simplifies the tax process, generates government revenue, and discourages excessive risky trading. Securities transaction tax is crucial to India's financial system. Though the tax rates seem small, they impact trading costs and investment returns. The system efficiently collects taxes while offering lower rates to compliant investors, encouraging market participation. Note STT rates as of October 2024, with futures rates increased to 0.02% and options rates to 0.1%.